Just like any Western country in the world, the inflation in Canada has peaked and now it is trending downwards. The December reading shows the inflation year over year is 6.3%, less than the expected in the market. But if you look at the monthly readings, it looks like the inflation has been stagnant since June 2022. But Bank of Canada is determined to raise another rate hike by 25 basis points next week, and this will going to further make the housing affordability very, very difficult. What's happening in the market, how the market is looking from an outlook perspective, we will cover all of this in this video, so stay tuned till the end. Let's go. Welcome back. My name is Yasin Nizami and I make these videos to educate my audience about the real estate market in Canada, particularly in the GTA, as well as some macroeconomics, some geopolitics, and some investment strategies as well. So if you are interested in any of these topics, consider subscribe, and let's get back to our topic of the day. So what we receive is the latest stats from Korea about the national housing market, and according to them, the sales volume has been declined about 40% compared to last year. So we're comparing the sales volume from December 2022 to December 2021. The listings have gone down by 14.3%, and the national level, the average house price has declined by 12%. As you know, there is no a real estate market. There is thousands of real estate market in the country, and every neighborhood is different. And if you look at the countrywide view, we see that every province is showing you a different picture. You know, Ontario and BC has been one of the worst performer as compared to the year-over-year pricing. But if you look at the Alberta and Saskatchewan, they have been pretty decent performer against other provinces in the light of rising aggressive interest rate. And don't forget the Atlantic Canada, we are seeing some decent numbers as well. Keep in mind these are year-over-year numbers, which means the market has been declining significantly since the month of February, and it has been going on pretty much every month. Now, if you look at the rental statistics, we have just received that the rents have been going through the roof, and we can see that at a national level, the rents are almost 12% up. And this chart shows you how aggressively the rents have gone up, since August 2021. And the main reason is because if the housing ownership has become so unaffordable, people have no other choice but to continue renting. Plus, the federal government is inviting a lot of immigrants. They have ramped up their immigration targets and expecting around 1.2 million people in the next year, and those people need housing to stay, which means the rents will continue to go up. It shows you the overall breakdown in terms of the category of the real estate segment, apartment, condominium, townhouses, and you can see pretty much across the board the rents have been going up. So last week we had the inflation data came out from Stats Canada, and according to them, the year-over-year inflation came down to 6.3%. Now this is less than the market expectation, which was a very positive news because now we're seeing the real impact of rising interest rate, which is kind of killing the demand across the board and bringing the inflation down. Now, year-over-year reading is kind of slightly misleading because it is still showing you the inflation is still too high. But if you look at the monthly readings of CPI, you can see that since June, we pretty much have less than 2% inflation, the CPI metric on average. And if this trend continues, we will see the inflation will very, very quickly come down to 2%, because if you average it out, the last 6 month data, it is sub 2%. And the reason is the oil prices have gone down significantly in the global markets, which have brought down the gasoline prices, which is one of the core fundamental in the CPI basket. But the shelter, the food prices are continue going up. So that side of the basket is still very heavy on the CPI index. But that doesn't mean that Bank of Canada is going to stop their rate hike this month. The economists are expecting that the Bank of Canada will continue with another rate hike of 25 basis points, and then maybe they will take a pause. And what the other economists are kind of arguing and debating, that the rates have already done a lot of damage in terms of killing the demand. We're seeing a sharpest decline in terms of the home prices across the country. If you look at the home price index, that shows you the steepest decline of house prices since this index was created The index was created in 2004, and since then we haven't seen that steep decline in the housing prices, which is pretty significant. So the rates have already done the damage in the real estate market, and now it is causing, or it is going to cause, a lot of trouble in the debt market, especially in the corporate sector, as well as in the individual household as well. Because if you look at the overall debt condition for Canadians, this is not looking good. Like if you look at this chart that compares the US and Canada from house price to income ratio, and you can see the Canadian stats are completely off the chart, and this doesn't going to end well, in my opinion, unless something is changed. If the income goes up, or somehow we close this gap between the house prices and the income. Otherwise, this doesn't look good. This brings me to another point where we see the home ownership cost. Because the rates have gone up so aggressively, the cost of carrying a real estate, the cost of carrying a mortgage has been so expensive, because we never had so much debt in the system, ever in Canadian history. Like people always compare, the rate hikes of this time back to 1990s, but my counter argument has always been, guys, the debt level back then was so low, it doesn't really matter now, because now the debt level has completely, off the chart, and a slight increase in the interest rate is going to cause a lot of financial trouble for anybody who is levered or who is highly leveraged in terms of the debt. And I know a lot of people have taken 2, 3, 4 rental properties on variable mortgage rate, and they are basically struggling big time. And any slight percentage increase in the rate is going to cause a lot of financial trouble for those individuals as well as corporations. Think about the institutional buyers. Although we don't have a lot of them in Canada, but they have some portfolio real estate market in Canada. They just look at the P&L on their balance sheet. If that asset is not producing any cash flow, they will be the first one to offload those assets from their balance sheet, and this will most likely increase the inventory going forward. Anyway, the time will tell. I think the next spring market will tell us, how resilient this market has been against the aggressive rate hikes so far we have seen in the modern history in Canada. But this has been very brutal, and a lot of economists are kind of debating that. I think the Bank of Canada has to stop the rate hike, because the rate hikes takes time to implement all those things in the economy. We're still going through the rate hikes process. It is going to continue make its effect, for the next 12 months. And all the economists are saying, I think Bank of Canada is going to overshoot, because they don't know how much damage it is going to cause further down the road in terms of the debt market, because this time we have the highest level of debt across Canada, at the government level, at the corporate level, as well as at the individual household level. So I think the Bank of Canada should wait now and see how this is going to evolve, because right now they're just blindly increasing the interest rate by looking at the backward looking data like CPI, like job numbers, like retail sales number. But this is going to create a lot of trouble going forward, which we haven't seen yet. So I think the next 6 months is going to be very interesting in terms of how the economy is going to evolve alongside with the real estate market, because things are looking pretty tight, to be honest. And if you see in the tech sector, a lot of job losses happening, which have not been reflected in the unemployment rate, which we will see in the next 2 to 3 months. Anyway, that's all from me this time. I think the market is still very tight. We don't have enough inventory, and the spring market will actually tell us, if the inventory comes up, how the market is going to behave with regards to already suppressed demand in the market. Anyway, let me know what you think, and I'll see you in my next week video. Take care.